Okay, good morning and welcome back everyone to our Tuesday morning market outlook session. My name is Tony Zhang. I'm the chief strategist here at OptionsPlay. And largely markets are pretty much in the similar position that we were last week, and very similar to the conditions that we've noted over the past 5 or 6 weeks or so. So today what we're doing is we're going to give an update on where we currently see, what we see opportunities are in this particular market and what has shifted a little bit in terms of the broader markets. Before we get started, what we are going to discuss here today is purely for education and demonstration purposes. It is not a solicitation or recommendation to buy or sell any specific securities. So we'll start off by taking a look at the broader equity indices. There's been some minor shifts in these indices, but for the most part, they are still the same in terms of what we have seen over the past few weeks. We'll take a look at fixed income markets. We have seen a little bit of movement here from bonds and rates. So we'll take a look at what has emerged and what our views are for bonds going forward. We'll take a look at sectors, commodities, as well as Bitcoin. We'll take a look at sector rotation model as the health of the market rotations continue to have, a lack of rotation, if you will. And it's important for us to understand which sectors are outperforming, which sectors are underperforming. And then we'll take a look at some of the economic indicators that, we've been looking at, but kind of maybe we want to revisit, if you will, with respect to inflation, with respect to monetary policy, and then taking a look at manufacturing data before showing you how we want to think about finding ideas in this type of market condition. But the primary question that I want to help investors answer from today's session is really, are the recent crackdowns here in China, do they present an opportunity here for investors? And that's really how I want to think about the markets here today. So my name is Tony Zhang. I'm the chief strategist here at OptionsPlay. And I want to share with you my technical research, my economic research, and again, how I'm trying to think about finding opportunities in the current market conditions that we are in. So if we take a look at the broader equity markets, like I said, not a whole lot has changed since last week. If you look at the weekly chart, very much still in that very strong uptrend. Daily chart, same thing, very much in a strong uptrend here, no doubt about it. Over the past week or so, the equity markets have been trading in a very, very tight range here between 437 here and 440 or so. So very small range here. But the one thing that continues to bug us, if you will, is the lack of momentum or the exhaustion that we're starting to see here in the broader markets, meaning as we push higher highs in price, momentum continues to decline here, both on the daily and weekly charts here. So you're seeing exhaustion here in the daily and weekly charts. And just from a timing perspective, if you draw a channel here on the S&P 500, we're very much at the top end of the channel. And this certainly would warrant at least being patient and waiting for a pullback here towards the bottom end of the channel before looking for long opportunities. So at the moment, you don't have a lot of downside opportunity. So I don't think shorting the markets in itself is a great idea. You don't have a lot of downside before it could potentially start to bounce higher here, but it's also not a great opportunity to go long because you're near the top end of the channel and you have this exhaustion here. So you're kind of stuck between a rock and a hard place here in this current moment, unless you start to see a decline here towards the support levels and you start to break down below those levels. Then you start to see some larger potential opportunities here in the broader markets to the downside. But we're just simply not there. We're kind of, again, stuck in limbo here. And you see this on the S&P and you also see this on the NASDAQ 100, where very strong uptrend, no doubt about the bullish trend here. But as you can see, as we push higher highs in price, no longer being confirmed by higher highs in momentum, we actually see a fair amount of negative divergence here as these equities move higher here. And again, we're near the top end of the range here. So it's concerning as to, adding onto new long positions. So as you look for, the other market indices, you look at the Russell 2000, notice how the Russell 2000 has made zero progress since February, the beginning of February. It was at 220 in the beginning of February. It is at 220 now. So in the last 6 months, this index has made no progress. And that's not particularly healthy when you see the S&P and the NASDAQ make all-time highs month after month, and then the small cap indices are not keeping pace. They're not confirming those new highs. That means that there's not a lot of participation in these market rallies. It's really just the mega cap stocks that dominate the S&P and the Nasdaq 100 in terms of weight that are dragging the markets higher. The small cap indices are not participating. The Dow Jones has not participated since May 5th when it made its a recent all-time high. It has failed to make higher highs, and multiple attempts to break out here over the past couple of weeks have failed, and we've seen a bit of a pullback here. We still can see these resume and start to confirm these new highs. We're just not there yet. We see it both on the Dow and the RSP, which is the equal weight S&P 500. Similar price action here after making that high on May 5th. Multiple attempts to break out here so far has failed. And notice how during these attempts higher here, momentum has continued to move lower here. So higher highs in price no longer being confirmed by higher highs in momentum. You see this again, both on the Dow and the RSP. So lack of market breadth, lack of market participation does not make a healthy market rally. And again, one of the things that we want to pay attention to here is that only 37% of all stocks right now are trading above its 50-day moving average. That's not the type of statistic that you would typically see when markets are at all-time highs. You want to see that number to be 70, 80%. That confirms the market rally that we're in. But right now, the fact that the vast majority of stocks are trading below its 50-day moving average means that you don't have participation in this particular rally. That in itself does not make a healthy market rally. Now, if you're joining us for the first time and you're seeing this type of information, you might be inclined to say, wow, this thing looks pretty bad. Maybe I should go out there and short the markets, and I want to warn investors. You see these market conditions that show you that the health of the market rally is not healthy. That in itself is not a good enough reason to go out there and short the markets, because the same conditions I'm showing you today existed about 5-6 weeks ago. If you saw these conditions 5 or 6 weeks ago and you went out there and you shorted the markets, guess what? You would have lost a lot of money trying to do that. I don't think I think it's fully normal for someone to look at this data and say, wow, I think I want to take a chance and maybe buy some puts. And that's perfectly fine. But the thing you want to make sure that you do is you want to limit your losses if you are wrong on a put like this, because it is more speculative. But we do have the makings of what could spark a significant downside move. We just lack a catalyst here at the moment. So what that catalyst is going to be and where it's going to come from and when it's going to come, that's the big question. No one really knows. But we certainly have some of the market conditions that could spark that type of sell-off. So this is really, what I mean by being stuck between a rock and a hard place, because you have this data, you see these metrics, but again, just having these metrics in itself is not a good reason to go out there and short the markets. And but the one thing that I do, the one good side, if you will, that I do see here that has emerged over the past couple of weeks is the fact that we've seen VIX climb back up into this 19 range. So as we made higher highs in price, we've also seen VIX start to climb. So this means that market participants are becoming a little bit more fearful of the current market conditions we're in, as that's reflected in the implied volatility of options. People are paying more for put options and perhaps paying a little bit more right now for protection at the moment. And that's why we've seen the VIX climb over the past 3 weeks as we've made new higher highs. And this could be useful in many different ways. If you are a believer that this is perhaps a temporary top here in the markets, you can sell cover calls and you're going to collect more premium as the VIX has continued to climb. If you're selling credit spreads, you're going to also collect more premium in this type of market condition. This is not the type of best condition to buy puts necessarily, because they're getting a bit more expensive. These types of market conditions warrant collecting premium so that if you get that catalyst could come tomorrow, it could come next week, it could come 3 months from now. These market conditions that we're identifying in itself does not mean we're bearish. It just means that as we continue to climb, these are the warning signals that you want to pay attention to, that typically signal that may show you a market top, but it doesn't mean that it is a market top. And the one thing I do also want to point out here is that all these metrics that I showed you, the lack of participation in the markets, the lack of confirmation from these other indices, that could resolve itself simply by having other stocks start to participate. Meaning if small cap stocks start to rally, if the RSP starts to confirm new highs, if the Dow Jones Industrial Index starts to confirm new highs, that in itself resolves the issues that we're that we're bringing out. It doesn't have to resolve itself in this spectacular violent sell-off that we did see the last time this happened, but that doesn't mean that that has to happen the next time as well. So there are two possible outcomes, if you will, to the current conditions that we're in. So I just want to clarify that for anyone who's viewing us for the first time. And then when we look at interest rates, we continue to see interest rates tumble. We saw a bit of equilibrium here around the 125 level here or so over the past few weeks as it kind of climbed above or below. We are near the bottom end of that range here around the 120, 119 basis point level here. So for this, I do want to point us to TLT to take a look at where bonds are currently trading. So remember, earlier last year, we had bonds break below this 155 level here, broke below, came back to retest it, and traded all the way down into the 132, 133 level here or so. So it's made basically a round trip back up to this 155 level. And we're just a few points shy of this particular breakdown level, if you will. We do have this temporary top right here around 152 or so. I would think that we're likely to reach that level very soon in the next couple of days and potentially back up to the 155, 156 to fill that gap, because right now we're very much in this strong uptrend here. And unless this trend breaks, that's really where we're headed next, towards that 156 level over the next few weeks or so. So we can continue to see yields decline even a little bit further. That will likely continue to elevate equities in the current market conditions that we're in. And we're going to take a look at a chart from a economic perspective that also supports that view. And then when we look at, Bitcoin, I just want to do a quick view here on Bitcoin, as a lot of investors continue to, trade these and stay aware of these, or maybe even investing in these. We talked about this 30,000, 40,000 range here on Bitcoin that has stayed here for the past few months. We made a small attempt here to break out here at the end of last week. It's failed that breakout. We're back into this range here. So we very well may see a bit, again, a retest of the 21-day moving average. We'll see if that holds. If it holds and starts to break back above 40,000 here again, then I would say that we've perhaps completed a bottoming formation, but we very well could also just see a breakdown back into the $30,000 range. So next couple of days, this 21-day moving average, very important level to pay attention to here, as that recent breakout did fail to continue to push higher here for Bitcoin. And then when we look at the sector rotation model, one of the things that I've been pointing out all along with this lack of confirmation from markets over the past, it must be extending into the 7th or 8th week now by now that we've been talking about this. This was also coupled with a lack of sector rotation. And again, the lifeblood of a rally is really a strong rotation from sectors. Sectors that are strong becoming weaker, weaker sectors becoming stronger, and seeing that rotation. And this rotation graph really gives us a sense for, whether or not sectors are rotating and which sectors are getting stronger and which sectors are getting weaker. And we still continue this lack of rotation that we continue to see. We don't see a lot of rotation here. We see a small amount of rotation from a couple of sectors, but for the most part, leading sectors kind of remained leading or were leading for a very short amount of time. And most of the sectors are either improving, lagging, or weakening here. So we really see a lack of rotation here. We only see two sectors currently outperforming the broader markets here. It's really healthcare and real estate. So those are the ones that we'll pay attention to here right now. So out of 11 sectors, you only have 2 sectors recently that are outperforming the broader markets. That means you have 9 sectors that are underperforming the broader markets. That, again, is not a healthy market condition. We saw this in January and February before the coronavirus sell-off. Pretty much going into Christmas before the coronavirus sell-off, we were talking about the fact that there was a lack of rotation, that there was markets were overbought, there were signs of exhaustion. And what we saw was that continued on for about 2.5 months before the coronavirus was kind of the catalyst that broke the camel's back, if you will. The question, obviously, we're not likely going to see a second version of the coronavirus that's going to break the camel's back here. And what is going to break the camel's back? That is the question here right now. But we are seeing many of the similar conditions that we saw back then. So what we have here is healthcare is one of the few sectors that is outperforming the broader markets. And what's interesting about healthcare is that it's been on a very steady uptrend here over the past week or so. It started to break above that uptrend. So we've actually seen an acceleration here to the upside. But I will say that acceleration is also coupled with some negative divergence here that we see here. The weekly chart has been confirmed with a higher high. The daily chart is starting to show signs of exhaustion here. And the other sector here is real estate, same thing. Real estate breaking out higher here, actually above trend, starting to continue to outperform the broader markets. But we also see the same type of issue here with real estate, where higher highs in price is being not confirmed here by higher highs in momentum on both the daily and weekly chart. So we have a lack of rotation here. We have markets that are kind of exhausted, that are showing signs of a lack of momentum here. But what we're lacking here is that catalyst. So in this type of market condition, it's not a great time to add to new long positions here in the broader markets. It's not a great time to go out there and short the markets just yet, but it is more volatile, which means that being more neutral, selling cover calls, selling credit spreads, these are the type of market conditions to do that. So taking a look at some of the economic data. So past 4 or 5 weeks or so, we were talking about, very strong debate as to whether inflation is more transitory or permanent. We seem to have moved past that a little. I think the consensus across the board from most investors, certainly if you look at bond yields, seems to have settled that debate with respect to the belief that the concerns around inflation is more transitory due to wages continuing to move in the right direction. We've seen employment move in the right direction, and we simply believe that the supply chain issues that are in place today will largely resolve themselves by the end of the year. This is not something that we expect to go on for a longer period of time. But I will say that the short-term inflation data continues to surprise us to the upside. Inflation surprise index continued to climb here this week, and this starts to put further downside pressure here on the Fed moving interest rates, because one of the things is that the Fed continues to make financial conditions extremely easy or loose here at the moment. And if you look at a chart of financial conditions, what's very interesting about this chart is that it has a very strong correlation to the inverse returns of the equity markets, meaning as conditions get looser, those are great conditions for markets to continue to rally. And we have actually seen financial conditions continue to move to extremes, and which is why we've seen equities at all-time highs. So the question is whether this starts to ease off a little bit and we start to have further support for keeping financial conditions loose, or if this continues to move higher here, and that puts down further pressure here on the Fed to move interest rates a little sooner than expected, because that really is the type of catalyst, in my opinion, that could move equity valuations with the Fed moving interest rates. We've seen this earlier this year where there was concerns that inflation was going to be more permanent and the Fed was going to move interest rates sooner, and we saw that reaction here from equities. So far, that's eased off here. Whether or not that's going to continue, these are the things that we're going to pay attention to here right now. And then when we look at economic data from a manufacturing perspective, we did see manufacturing PMI come in a little softer than expected. 61 was expected. We came in at 59.5, even though that still remains fairly elevated, I would say decade highs here in terms of manufacturing. We did come off the peak. I will say that, if the supply chain issues start to ease, we do expect manufacturing to actually continue to rebound and be fairly strong here. But we have seen manufacturer prices paid come down quite a bit. So the survey at 89 coming in at 85 and at 85.7 means that we have seen a bit of a peak here in terms of the supply chain constraints, if you will, that we have seen here this year. So signs of constraints, but again, still remains fairly elevated here when we look at the prices paid, also at multi-decade highs in terms of the prices that manufacturers have to pay for the goods and the wages that they need to pay in order to continue their manufacturing. So inflation remaining fairly elevated here, but manufacturing remains also fairly strong. We could see a further rebound here if some of these supply chain issues start to ease and wages start to ease. We could see also a rebound here in manufacturing. So how do you look for opportunities here in this market? And that's really what I think is quite tough here in the market, because you're at all-time highs. Timing perspective to push new all-time highs, not a particularly great time to do that. It's tough to find needles in the haystack in this type of market condition where everything is trading at very rich valuations, everything's trading near all-time highs, and you're concerned about a pullback here in the broader markets. And then you look for short opportunities here in this market, and you see that a lot of the weak stocks are already trading near the bottom end of the range, not particularly great opportunities to short those stocks either. So how do you look for opportunities? And that's really where I think the shift, if you will, that we've seen here over the past couple of weeks with respect to the Chinese crackdown of technology companies, gaming companies, education companies, companies that the Chinese government deems not supportive of their brand, of their broader vision, or perhaps distracting from their broader vision, or at risk to their broader vision. Those are the companies that have seen a substantial slide here over the past couple of weeks. But the Chinese government has been cracking down on some companies for quite some time. And one of those names is Alibaba. And this is a name that I have stayed away from for quite some time. And I've warned investors saying that the Chinese regulatory conditions are not ripe for this type of investment. But it does seem like we're perhaps turning a bit of a leaf here as Chinese governments are paying more attention to some of the excess parts of the economy that they think are driving excess valuations, and kind of stemming away a little bit from e-commerce and kind of the type of companies that are perhaps more conducive to the growth of the Chinese economy. So Alibaba, I do think, is now at a point where it's worth paying attention to now, even though for the past 6 months or so, I've said largely to stay away. Because when we look at the charts here, first of all, you see a bit of a capitulation here on the weekly chart. We've seen multiple weeks of lower lows in price, no longer being confirmed by lower lows in momentum. So we certainly have that positive divergence here. You have this giant accumulation bar here in terms of the weekly candle. That certainly shows a bit of capitulation here to the downside. If you look at the daily chart, same thing, lower lows in price, no longer confirmed by lower lows in momentum. So positive divergence on the weekly and daily charts. And not to mention here, at 200 or so, you're basically back to the prices that Alibaba was trading at back in 2018. And we've doubled revenue since then, and we've doubled EPS since then. So for those reasons, I think Alibaba is worth paying attention to here. It's a bit more speculative in nature because we never know what the government could do in China to further erode these valuations here. But I do think that, at this point, now that we've have the valuation here, it is potentially worth paying attention to here at the moment, especially when you combine the technical factors that have shown some capitulation and show some signs of we're near a bottom. And then on the flip side, looking at industries that the Chinese government does want to support and wants to, kind of leapfrog, if you will, the rest of the world in terms of technologies, well, autonomous driving is certainly one that fits that category. Semiconductors, autonomous driving, artificial intelligence, these are the types of industries that the Chinese government does want to support. So when you look at XPEV, which is one of the leaders, I would say, of autonomous driving in terms of the Chinese EV players here. What's interesting is that you've had this strong move here over the past couple of months from 22.5 to 42.5, so about a $20 move here to the upside, roughly a 100% move in the underlying stock. And you had a consolidation range, which is normal after such a strong move. And now what we're doing is we're starting to break out from that range. And this would certainly project up to about 62.5, which corresponds largely with this recent high here from February or so, around $60. I think that you could make a move here around 60 and potentially even project up to 75 or so, a 100% move from 42 up to about 75 or so. So this is really where I do see some potential opportunities that we have in this current market condition, taking advantage of, some of the strong numbers that have continued to come out of these stocks that while the stock has really kind of traded sideways here, looking for now potentially a breakout here from these types of Chinese EV stocks. And then lastly, when you look at potential short opportunities here, this is really where you want to focus on the fundamentals. You want to make sure that you have a stock that's fundamentally broken, if you will, in terms of a model. And First Solar certainly fits into that category. It's seen zero revenue growth here over the past 4 years or so. We've actually seen some revenue decline. And over the past 4 quarters, we've seen continued revenue decline over the past 4 quarters. And earnings is moving in the wrong direction. Last quarter, recent earnings that just came out made no profits on the earnings. So over the past few quarters, they've been able to turn a profit. But the recent quarter, they've actually are no longer turning a profit. So everything about the fundamentals of this company is moving in the wrong direction. And what we have identified here is that this stock is trading within a range between 70 and 90 or so. And right now we're at the top end of that range. So this is the type of opportunity where I'd look to sell some premium, sell a call credit spread, and look for a bounce towards the lower end of this range here. And this is really an example of where you try to line up the technicals with the fundamentals of a stock that's somewhat overbought, but looks at some of the technical factors that give you a better understanding as to timing, because the same issues existed down here, but the timing just isn't right. You want to wait for the top end. When it gets to the top end of the range, look for those types of short opportunities. But also, the most important thing to remember is that you want to use limited risk strategies, buying a put spread, selling a call spread, so that even if First Solar does start to break out here back into this 110, 112 range, you have a control over how much you are risking on that particular trade. And you should always be comfortable with any single trade that you make, that if you lost 100% of the max loss on that trade, you can survive to trade another day. One of the most important aspects of trading is risk management, not necessarily calling the markets or knowing where the markets are going to go. The more important thing that's going to help you survive the day-to-days of volatility of trading is proper risk management. So with that, that covers what I wanted to share with you here today. I hope that this was helpful in giving you a better understanding as to where the current markets sit, what the market conditions are, and how to potentially seek for opportunities here in this market. With that, thank you so much. I hope you guys have a great trading day, and I'll see you guys here on Thursday for our next options education session and our rapid fire session this Friday. I'm really looking forward to that. So please submit your symbols for a rapid fire session for those of you that are members, so that we can look at your symbols together on Friday. Thank you so much and have a great trading day.